Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 144 on December the 12th, 2020. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Nano Dimensions Limited, iQiYi, Inc ADR, and American Airlines. And we discuss three new trades on Electrameccanica Vehicles Corp, Pfizer, and United Airlines. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the stock market finished the week without much change of significance. Both the Dow Jones Industrial Average and the S&P 500 index changed less than 1% week over week. The Dow Jones Industrial Average lost 171 points, closing at 30,046 points on Friday. The S&P 500 index lost 35 points, finishing the week at 3,663 points. Now it's time to get into the topic of the week. This week, the topic is about using leverage. And let me start right off the bat by letting you know that leverage isn't always a bad thing. That might be contrary to what you've been taught in the past. And of course, I'm not talking about trading on margin or borrowing against your home, your car, your kid's college fund, or any of your other possessions or assets to be able to trade. Options actually have a built-in leverage mechanism due to the fact that each option has the equivalent of 100 shares of stock. So a much smaller amount of capital allows you to create a position equivalent to having traded 100 shares of stock. There are some other assets that really allow you to use leverage to your advantage simply by the nature of their actual setup or their design and construction. I'm speaking specifically about the ETFs that have a multiplier as part of their pricing. Many of these ETFs have options on them as well, which is like adding leverage on top of leverage. So last week I mentioned wanting to acquire some puts in the equity markets, specifically the indexes like the S&P and the Dow. And I can actually buy call options on an inverse ETF with 3 times leverage on the major indexes. So I've been looking at the Direction Daily S&P 500 Bear 3X ETF. The symbol is SPXS. S is in Sierra, P is in Papa, X is in X-ray, S is in Sierra. And I can buy call options on this ETF, and that is actually shorting the market because I'm buying a call option on something that increases when the market increases 3 times when the market goes down. So it's sort of this sort of mind puzzle, which makes sense once you understand it. And the ETF actually that has more volume is the Direction Daily S&P 500 Bull 3X ETF. The symbol for that is S is in Sierra, P is in Papa, X is in X-ray, L is in Lima. Since the ETF is a leveraged long, a 3 times leveraged long play, I can actually buy puts on that and still get sort of the same effect because once it goes down, it's still going to take a 3 times hit. Now, of course, when you buy options, you still need to be correct on both the direction of the market and the timing. Therefore, I'm looking to buy options that have enough time for me to see the move I'm expecting in the stock market. So I'm looking past January expiration, ideally February or March. You still have to be aware of the fact that you're paying for time. So I have an idea of how much I'd like to pay for the option, and I really can't go beyond that. Otherwise, it's going to skew the results of this trade. Because remember, you don't have to have the option actually go in the money to make money on the option. You can still double or triple your money long before you get to where your strike price is actually in the money. And the other thing I like about taking a short position on the market this way is that I'm actually, when you buy options, you're limited, your risk is limited to the capital that you put up front. So if I allocate, $1,000 or 5,000 or whatever to this trade, that's the most risk that I'm going to have on this trade. It's not like going out and shorting the S&P or the Dow futures market, or just selling the spiders or the diamonds ETF, where right from the start you're going 1-to-1 on your profit or loss. With the options, I'm going to have limited risk and still a bit of not an unlimited. When you're buying puts, it's not an unlimited upside, but it's going to be pretty close to it, because stocks don't go below zero. So I'm going to have a pretty nice upside if I get any downward movement. So that's what's been on my mind lately as far as trading goes, outside of the scope of what we talk about on the show normally. Last week I mentioned that I'm going to be having a class, and we will discuss these concepts and many more like this in the upcoming course. It will be a mix of videos and live training calls online. So the course will pay for itself in like a trade or two. That's my goal. That's the way it's designed. Really, it's just to help speed up your options knowledge, and get you fully in the game if you're not already, with both direct online video courses that you can take at your own pace, along with live calls, so that we can really get you up to speed and get some trades going for you. I've received emails from several of you already. I will follow up with each of you this week, and those who sign up for the class will be able to access the video portion of the class beginning next week, the week of December 21st. So you'll have a couple of weeks before the live trainings begin. We'll start the live trainings after the new year, and those will be a weekly phone call, and we're going to get into some actual trades as well, so you can follow along with me or actually discuss things that you're looking at. So this will allow you to have plenty of time to watch the videos at your own pace before the live class begins. And if one of your goals for 2021 is to become a better trader, email me so that I can share the details of the class with you too. Now let's get into the trade review for last week. We're going to start off with the covered call. We looked at Nano Dimension Limited ADR, symbol N as in November, N as in November, D as in Delta, M as in Mike. At the time, the stock was trading for $7.44 per share. I looked at buying the stock and selling the December 7.5 call at 91 cents, which can give you a maximum return of 13% in 2 weeks. Now, Nano Dimension stock fell $1.30 per share, ending the week at $6.14 per share. The call option that we sold can be bought back for 22 cents, locking in a 69-cent profit on the option portion, but a net loss of 61 cents for the week. Now, typically, I will look at rolling this option strike lower, but the next strike in this option chain is an in-the-money option. I don't like rolling the call option to the next month unless you're certain the stock price will increase. Like if you're a believer in this stock, then consider rolling it. But if not, I'm not a fan of continuing to have the risk on. I would actually lean more towards taking the loss on this trade and moving on to the next opportunity to give you a better shot at locking in a profit. Now our next trade from last week is iQiYi ADR, symbol IQ, I as in India, Q as in Quebec. And let me apologize right off the bat if I am calling this, I think it's iQiYi. I can't pronounce the name of this. It's a Chinese ADR, but nonetheless with the stock symbol, I'm sure you found it, IQ, I as in India, Q as in Quebec. At the time, the stock was trading for $23.03, and I looked at selling the December 23-22 half put spread at 20 cents, which could give us a maximum possible loss of 30 cents. Well, IQ stock fell 48 cents, closing at $22.55 per share on Friday. The out-of-the-money put spread we sold is officially at the money. The spread's value has increased 18 cents, which gives us a loss of 18 cents for the week. Now, with just 1 week left until December expiration, our options they've got a limited amount of time value. So I would consider selling the December 23 half 24 call spread at 9 cents. That at least cuts part of your loss on the week. And it also lowers the maximum loss you can experience on the trade. Now, because I'm short in the position, I'm short the December 23 put, and that put is 45 cents in the money, I have just about lost the maximum value on the spread. So considering that, I would actually exit the trade, ideally for the mid price on the spread of both strikes. Now the current mid price value on that spread is 29 cents. If you can close the entire position for 29 cents, that means only a 9-cent loss, and you avoid losing the possible loss of 30 cents on the spread. And I would say that's a win. So understanding options, and that's part of the reason why the show tends to be a little bit longer when I lose, is I get to explain kind of the fundamentals. So yeah, I can look at this as a spread, and then I'm able to look at each option individually so I fully get what's about to happen at expiration. And then it also allows me to decide fully, is it worth selling the call spread against it to take in more money, or should I consider closing this one to avoid maximum loss? And if I do close it, what would be a good limit price to put out there to try to sell the spread? Most of the time, I just use the posted bid-ask spread and not take a mid price. But when you look at the mid price of the spread, you actually have a good shot of putting a limit order out there that gets bought and gets you out of the trade for a much smaller. I mean, I'd take a $9 loss in real terms any day over a larger one. So that's it for that one. And then we're going to get into next up the debit spread on the week, which was at least a true win. We looked at American Airlines, symbol A as in Alpha, A as in Alpha, L as in Lima. And at the time, the stock was trading for $16.40 per share. We looked at buying that December 15 half 16 call spread for 30 cents, which can give us a maximum gain of 20 cents or a 66% return in 2 weeks. Thankfully, this one worked because shares of American Airlines gained 65 cents, closing at $17.05 per share this week. The in-the-money call spread that we bought is even more in the money now, and if we were to sell the bid of the spread, we would actually lose 3 cents on the spread, which is funny. However, we know that this call spread is fully in the money and will expire for 50 cents by the end of the week. Even if you aren't as comfortable with trading spreads, just look at the options individually. You own the 15 half call, which we bought, and that's deep in the money. The December 16 call we sold is also in the money. So the 15 half call, which we own in this, is $1.55 in the money. The short strike, that's the December 16 call, is $1.05 in the money. So the difference between the intrinsic value of both individual options, the one that you bought and the one that we sold, is 50 cents. This means that we should make 20 cents per spread, or the gain of 66.7% return on our capital. So that's it for the week. This week upcoming is obviously December expiration. So December 18th, any December expiration or expiry options that you have will either expire for their intrinsic value or at zero. And we're going to go ahead and dive into January expiration options on this week's show. So we'll start off as usual with the covered call, looking at a company I haven't looked at before, Electrameccanica Vehicles Corporation, symbol SOLO, and that's S as in Sierra, O as in Oscar, L as in Lima, O as in Oscar. The stock ended the week at $6.44 per share. I'm looking at buying that stock and selling the January 7 call at $1.10, which could give us a maximum return of 25.78%, almost 26% return in 5 weeks. Now, you enter this trade by buying solo stock for $6.44 per share and selling the January 7 call at $1.10. This trade makes the most money if stock prices finish above $7 per share. The break-even price on this trade is $5.34 per share. Now, in real terms, the stock purchase would require $644, and you would collect $110 for selling the option. Next up, we're looking at a credit spread on Pfizer, which has been in the news a lot, obviously, with the coronavirus vaccine. The symbol for Pfizer is P as in Papa, F as in Foxtrot, E as in Echo. The stock ended the week at $41.12 per share. I'm looking at selling the January 40.39 put spread at 40 cents, which could give us a maximum possible loss of 60 cents per spread. Now, you enter this trade by selling the January 40 put at $1.93 and concurrently buying the January 39 put for $1.53. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices stay above $40 per share. The break-even price on this trade is $39.60 per share, and in real terms, you'll receive $40 per spread that you sell and have $60 at risk. Then our final trade on the week is a debit spread on yet another airline. But they just look good right now. Looking at United Airlines, symbol U as in uniform, A as in alpha, L as in Lima. Stock ended the week at $48.36 per share. I'm looking at buying the January 47.48 call spread for 65 cents, which gives us a maximum possible gain of 35 cents, or a 53.85% return on your capital in 5 weeks. Now, you enter this trade by buying the January 47 call for $4.70 and concurrently selling the January 48 call at $4.05. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices remain above $48 per share. The break-even price on this trade is $47.65 per share. In real terms, you'll pay $65 to enter the spread, and your maximum gain is $35 per spread. Now that's it for this week's show. Thank you guys so much for listening. Thank you so much for sharing the show with other people who love option trading too. We are a large but small community relative to the larger stock trading world, and I love that you guys actually come on the show to listen to option trades every week. Just blows my mind. So you're awesome. Of course, don't forget about reaching out to me if you have an interest in learning some more about the upcoming class. Have an amazing weekend, and as usual, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.